So basically in this question, Nelson Corp paid $1 million of cash to acquire 100% of Orange Corp. So we're going to use the acquisition method since the percentage ownership acquired was greater than 50%. And since it's 100%, there's not going to be any non-controlling interest. So we need to use our 6-step approach for the acquisition method to record the journal entry, because ultimately we need to figure out what amount of goodwill will be recorded. And that's step number 6 in our 6-step approach, right? So as always, let's go through the 6 steps, figure out the journal entry, and that will give us the correct answer for this question. So our first step is to credit for the investment in investee, right? And this is basically to record the cash paid or the purchase price for the acquisition, right? And that was $1 million. So for step 1, we'll credit for $1 million. Now, since they acquired 100% non-controlling interest, that would be $0. Right, so that's the credit side of the entry. We may have to come back and plug the gain if applicable, but maybe not. So in step 3, this is where we would record the book value of net identifiable assets. Right, since they're purchasing 100% of it, really with the acquisition method, we absorb the book value of the assets. And so when we look at the book value column, we could either add up the assets and then subtract out accounts payable, right, which equals $275,000, or we can just take stockholders' equity, since that also equals net identifiable assets, right? So that's going to be a debit for $275,000. Now, step 4 is the adjustment to fair value. So what we need to do is sum up the fair value of the assets and liabilities acquired, and then subtract the book value of the net identifiable assets, and that will give us a difference, right? And that is what we would plug to adjustment to fair value. So the fair value of the assets acquired would be the cash for $100,000, marketable securities for $250,000, and land for $300,000. So when we sum that up, that equals $650,000. But we have to subtract out the liabilities as well, right? So that's minus $75,000 for accounts payable. That gets us down to total fair value of assets acquired of $575,000. Now, if the net identifiable assets book value, right, was $275,000, well, the difference there is $300,000. So that's going to be a debit for $300,000 for step 4. Step 5 relates to identifiable intangible asset fair value, right? But there's nothing that indicates any intangible assets in this question, right? So that's going to be 0. And then we get to step 6, and in order for the debit side to balance with the credit side of $1 million, well, that means we're going to have to plug goodwill for $425,000. So if you think back to the intangible assets module, right, goodwill was calculated as just the purchase price minus the fair value of net identifiable assets acquired. So it's the same thing here, except we just have expanded on it for this 6-step approach for the journal entry for the acquisition method, right? We would still get $425,000 of goodwill. Now, since that's what the question's asking for, that's going to be the correct answer for this question. So overall, this is your 6-step approach. It's really straightforward as long as you practice these steps.